We often get asked the question, we know you guys are positively disposed towards South African assets, securities. How do you manage the downside risks in case something bad happens in South Africa? But first, I just wanted to remind you of the opportunity set in South Africa. When we look on a global perspective, we think South Africa is potentially a standout opportunity. We've got some of our best opportunities from a global perspective sitting in our own backyard. And these are some of them. If you look at this chart, it shows the basket of South African-facing securities, equities, so SA Inc. equities in our PSG equity fund. And it shows the price-to-book valuation ratio, shows that basket going back in time. It just compares that valuation of those shares going back since 2002. So this is not a valuation of the fund, it's a valuation of the underlying basket of shares that we currently own going back in time. And what's interesting to us is that we see that we're significantly below average in terms of the long-term valuation, but even lower than we were in 2003 and 2008. And these are some of the opportunities that we reference in our funds. All mutual, 5-6% dividend yield, 8 times earnings. And when I give you some of these valuations, just bear in the back of your mind that the average company in the JSE Stock Exchange is trading at around 16 times historical earnings, give or take. Could be 14, 15, 16, but that's just kind of the ballpark figure. Hudaco. We've talked about Hudaco a lot in the past. It's a company you've owned for many, many years. Hudaco has compounded its shareholder returns over the last 20 years at over 20% a year. Far in excess of the average company in South Africa. Yet it's trading at a big discount. It's trading around 11 times earnings. Reunert, 7% dividend yield. The lowest price to book it's been since 2000. Gustav and I met with the company management team a couple of weeks ago. They were talking about how they were getting onto the front foot in terms of an earnings profile in some of their businesses. Supergroup is a business we've owned for a number of years. Great management team, we think very good market positions. Supergroup is approaching valuations where we started buying them in 2012. The share price has actually held up relatively well, but the earnings have continued to grow, and the share price has been left behind. Absa, a new CEO, potentially now a new management team, potentially a new direction. Absa, it was trading when I actually started referencing these comments at around 8.5 times, but it's actually starting to move higher in terms of the share price. But you're getting around 7% dividend yield, 8-9 times earnings. On a business with a rock-solid balance sheet, lots of fears around the management team, and that's starting to potentially clear. And we think that the earnings in this business are low. These banks just haven't been lending over the last 5 years. Tongaat Hulett. Tongaat Hulett has been an excellent teacher for us. We learnt about investing early in businesses. It's been a really rotten performer in our funds. But when we look at it and we circle back, the business has been through an absolute perfect storm over the last couple of years. But we reference the valuation, we reference the fact that it's got a new management team in place, and we reference the asset backing. If you do a conservative value of their sugar business, we look at the land that they have in their portfolios, and you're getting surplus land for free. It's a long road, but we're thinking we're approaching a closer inflection point on the sugar business, which could be very, very good for the outlook in this business. So I think there's a simple message when we're looking at our portfolio construction. Though we do think that South Africa is a standout opportunity, we're not all in on South Africa. We don't have a one-way binary bet on this country. And this is just the asset allocation of the PSG Flexible Fund at the end of December. And you can see the gold shaded areas are the actual SA Inc. or SA facing securities that we own. That's roughly around 46% of the fund. We're sitting around 10% in cash, which is South African domicile, but will have a lower correlation with the other two assets. But we look on the other side, this fund is made up roughly around 45% of high quality offshore securities, or securities that are rand hedges, that would benefit or would offer some diversification or mitigation factor if something bad happened in South Africa. But those companies on the right have to stand on their own merits. We're not buying companies for the sake of diversification. And I think that was a big risk that a lot of people in the country made in the last couple of years, when there was this almost tunnel view that South African rand hedges are blue chip, large cap quality companies, are low risk because they are XYZ, plus they protect you against a bad outcome in South Africa. If you buy expensive insurance, you will get a bloody nose. So these companies have to stand on their own, but they do form a part of cheap insurance in our portfolios. And what's interesting in terms of what a difference a year makes in global markets. When we stood up this time last year, we were cautious about global equities. We had it red on the dashboard. And the price to values, so for all the securities that we invest in, we generate what we call an intrinsic value, which is the value that we think is the realistic valuation of that security. We're just comparing the price to that. And if you go back over a year to now, we think we're getting 60 cents in the rand opportunities or 60 cents in the dollar opportunities. And the inherent margin of safety has risen significantly. The last point from me on this in terms of mitigating downside risks, and this is something that I've talked a little about in my preceding comments. But when we reference confidence as low as it is, at 40-year lows, and prices as low as they are, these rolling 5-year returns as low as they've been in 40 years, we don't know, we'll never know in fact, but we might find out in hindsight just how much of the value is currently priced in. We're not saying that the low road is being priced in, but at least some of the low road might be priced in. Just enough to give you pause to think about the asymmetry in terms of optionality upside that's embedded in our portfolios.